Today, we're discussing real estate investing, questions you need to ask your CPA. Hello, everyone. I'm Jemea A Kingsby at Miami_real estate. And today I'm pleased to be joined by the founder and CEO of Modern CPA Group and the president of the Atlanta chapter of the National Association of Black Accountants, Mr. Ric Sinordo, CPA. Welcome, Ric. I appreciate you taking the time to chat.
Yeah, thank you. Definitely. It was my pleasure to come on here and join you for this chat. Looking forward to it.
Excellent. Yeah, I think we've got some great talking points ready to go. And I've been able to have several conversations with you since I personally started working with you as my CPA. But for the audience, do you mind just sharing a little bit about your background so people kind of know who you are?
Yeah, definitely. As you mentioned, my name is Ric Sinordo. I am a CPA. For those of you who don't know, the acronym is Certified Public Accounting. I'm based out of the Atlanta area. I've been in the Atlanta area for about 6 years now, but I'm originally from Florida. Been in Florida prior to this all my life. I was born and raised down in Fort Lauderdale, Florida. Let's see. So my parents are actually from Haiti. So I'm
Haiti in the
born.
house.
Yeah, so firstborn. And so I got into accounting, just because I had a knack for numbers and finances. And after being in the accounting field for several years, working with big companies and, doing some consulting work on Fortune 500 companies, I just felt like that I wanted to connect more with individuals, business owners, and just help them keep more money in your pockets, right? So that's why I ended up starting my own business and just being able to have that touch point and making a bigger impact and actually seeing that impact.
I love that. I love that. That's a great story and how you just built up and saw, hey, this is what you needed to do and directly connect to the people. I love that.
Yeah,
It's
definitely.
powerful. It's impactful,
Definitely.
So I know there's a lot of questions as far as real estate. I'm going to speak today, really, I think the questions are from more of the investor standpoint, those that are first-time investors, those that would like to, or just curious about it. Maybe this is just a thought that's come up after 2020, after 2020 in the year that we've had. I think a lot of people have kind of thought about restructuring how they can kind of build their own wealth. And I think there's just some really great points and tips that you can bring to the table to help them get started. And I think one of the first and foremost ones is, can I afford to buy a property? So can you kind of break down when you're reflecting like the gross monthly income, or if there's other properties owned, what are you looking at to kind of help people know if they can even afford an investment property?
Yeah, definitely. And it's funny because a lot of times, can I afford investment property or property in general? It comes down to not necessarily can they afford, but how much can they afford, right?
I like that.
Yeah, because sometimes if you're already in a position that you're thinking that way, you probably have the room to do it. It may be a year from now, it may be right now, or maybe 2 years from now. Sometimes it's just kind of laying that plan out. But once you get to that stage and you're saying yourself like, okay, how much can I afford and what can I get? I like to think of it from this perspective, right? So, you have of course, that additional income, discretionary income that you want to spend on a property. I like to ask people, how much money are you willing to spend and still have your quality of life, right? So if you are looking to purchase a property, but you know that you'll have to spend a lot of time still working, a lot of time to a lot of your actual resources will be going to that property, then you may be too high, that property may be too high for you. So you want to ask yourself that question too, say, okay, if I am used to traveling, if I'm used to spending time with my family, or if I'm used to spending resources for family activities and things like that, you're not wanting the property to be able to take away from those things. So that's kind of first and foremost, kind of getting that
resource allocation. Where are you putting
exactly.
it? Okay.
Exactly. Get that threshold, and what's the sweet spot to where, hey, if I have a lot of resources going into this property, can I still live my life the way I want to live?
Yeah.
So that's kind of like the first stage to go. And then of course you get down to more of the specifics with, your how much of your down payment, how much available cash you have, how much in reserves. You'll get down to those foundational financials where, the banks, the lenders will kind of speak to what they want as far as being able to approve you if you're going through financing. So those are kind of the two different areas I kind of tend to look to and kind of speak to people about when looking at can they afford, or how much can a property they can afford.
Do you kind of do a recommendation for your clients as far as like what size of the down payment that would be most beneficial for them? Do you provide something like that?
I would say somewhat indirectly, right? Because again, it's about resources and where you want to put your resources, where you want to tie it up, right? So
Yeah.
obviously taking a certain amount of cash and putting it in property, depending on the cash flow, if you're looking at renting that property out and getting a return on it, or if you want to put in certain amount in the property, but you're also looking to invest into other securities like stocks and trading and things like that.
Okay.
We kind of, whenever I talk to someone about doing that, there's leeway, so it's flexible and it's different depending on everybody's goals. So you always want to keep in mind the goals that you want, and that'll help you determine, how much do you want to put in, because the banks, of course, will let you know how much you'll be approved for if you put a certain amount down. So you have that window and you have that leeway between, let's just say, you can do an extra 10 or you can do an extra 15, but it won't hurt or change the approval process.
Okay.
It's now more so about like, what else can I do with this resource, with this cash, that I may want to do? And that's more so of an opportunity cost.
Okay.
The cost of using the cash for something else.
The liquid, where are you going to move the liquid funding from?
Exactly. Okay. So if plan A is using it to purchase a property and plan B could be investing it or anything like that into something else, then plan B technically is that opportunity cost. So you just got to weigh the opportunity cost to help you determine how much you want to put down on the property.
Okay, that makes perfect sense. And now I'm feeling like we have to have a whole separate conversation about what I need to get myself together here. So,
that's how I think nowadays, because it's more so like, okay, I have this amount of cash, whether it's business income, whether it's from an investment, from selling stocks, and then I always sit down, and say, what do I want to do with this?
Yeah.
So it's like there's different options.
There are so many options too. That's the thing. It's just, it's kind of difficult if you're not in that space to know where are the best options, where to start. I think starting with asking a professional like yourself is the first start. That's the step. So that's helpful. Okay. The other thing I'm curious about is taxes. That's the thing. So from the real estate perspective, tax implications, the benefits of buying an investment property ownership, like what does that kind of look like? Are there benefits from your perspective?
Yeah, there definitely are. When you think about, and we'll keep going with the rental as an example, right?
Yeah.
Obviously with the rental income, it's taxable, right? So it's taxable income.
Okay.
However, with your expenses on that property, you are able to deduct your expenses from that rental income. So at least you're not needing to pay taxes on the entire amount of the rental income.
Yeah.
So you're able to do things like depreciation on the home, on the property, also doing property taxes, and as well as any interest for the loan that may be on that property. You are able to deduct those.
The interest as well.
Yeah, interest as well as repairs and maintenance, and those expenses you're able to deduct from the property. So you do get that benefit there from a tax perspective. A lot of people think about, getting additional income and having to pay the taxes on it.
Yeah.
But you think about it's additional income, so it is kind of a good problem to have because
right.
it's like you'd rather have additional income, and yes, you may pay some taxes on it as opposed to not having additional income at all. So
exactly, you have it to I don't want to say lose it, but you have it to wiggle with.
Wiggle with it, exactly.
I wanted to ask something really quick. You mentioned depreciation, and I want to just make sure everyone understands what you mean by that. I automatically knew, but I just realized. Can you just break down depreciation for us?
So usually, and it's interesting. It works a little differently for rental property, where normally, so normally when you think about it, so there are two different types of assets. You have your appreciating assets and your depreciating assets. One of the commonly known depreciating assets is a vehicle,
a car.
Right? Yeah. So they said you buy the car, $30,000 car, you drive it off the lot, and the value drops a little bit.
It's the worst.
Exactly. So that depreciates, right? Unless we're talking about classic cars and things like that. But a normal Honda, Toyota, Mercedes, they all depreciate in value.
Porsche.
Porsche, yes. So that's depreciation. It's the value that is going dropping off, and the amount that it drops off is what's considered depreciation.
Right.
So on a home, because we're always thinking about or property, we're always thinking about that getting a return on it and that it should appreciate. Obviously, we know that the market influxes can change home value.
Right.
But so what the IRS allows you to do is say, hey, I have this home, this property. I want to be able to take, you can be able to take that same depreciation. So the same concept from the car that you can take the depreciation on a home for wear and tear and things like that.
Yeah.
And you can take that deduction every year on your taxes. For most properties, for buildings right now, it's about 27 and a half years that you can do the depreciation, take the depreciation on.
Wow.
So when I said property depreciation, that's what I was referring to. Yeah. So it's
that's huge. I hope everyone understands that. Like that's every single year let's compare to a car, right? That means that every single year, talking about your engine breaking down, that would be like you getting money back.
Correct.
On it losing money, like on it losing its value. So that's applied to a home. So depreciation is an amazing thing within the housing market. Because it was such a good point. I just wanted to ask about it, just to really dig into that a little bit.
Yeah, not a problem. Sometimes, we say things.
Yeah, the acronyms are running and it's like, yeah, I got
yeah.
All right, excellent. Okay, so we're kind of talking about the implications, tax implications, but I also want to ask you about ownership in the structure that should be chosen. Do you have any tips as far as ownership, especially for business owners and entrepreneurs? I think that might be more specific to those folks, but I just want to hear your take on that.
So it's interesting when it comes to rental properties, and what I see a lot of times too, people have rental properties and you don't necessarily have to create a business and put that property under the business. So like an LLC, right? And this is from a tax perspective. From a tax perspective, it's still going to get treated the same as to where you have rental income, and you'll still be able to do those deductions that we talked about, whether it's under an LLC or just under your name. Where I believe the differences come into play is just more so from a legal and liability standpoint. Obviously, if you're renting it out and you have tenants there, you want to make sure you're protecting your assets as well. And so that's when we talk about a structure, you may so want to think more so a little bit to the structure for the liability purposes in that regard. And then so you do have some other instances where if you're looking at a trust or if you're looking at about passing on that property or
generational wealth building right there, that living trust. Just check the video. I've got one out there on it.
Perfect. Yeah. So the generational wealth there, definitely check that video out. Talking about that, just passing down the property. I remember speaking to a client some months ago where they inherited a bunch of properties, about 20 different properties. They actually, so for them, they actually had placed the properties under an LLC and handled it that way. So you definitely want to consider, okay, passing this along, and actually you not wanting to let taxes or the next individual who's inheriting it take on much taxes. So that's where some of that estate planning comes into play. So you just gotta speak to someone who's specifically handles estate planning, and then they can help you out with that a little bit more with the structure. From a tax perspective, your income, rental income, and as well as those deductions, expenses, you'll still be able to use those whether you just have it in your name or if you have it in your
side. Okay, that was a good question. I really wanted to kind of figure that out because from a legal, it really matters. Speaking with a lawyer about it, but from tax point, it's the same. It's one and the same essentially. There's no real exposure, negative or anything there.
Correct. And then the one I guess you could say asterisk, right, that I want to throw in there that just came to mind is that so there are certain laws that will have like with property be considered more so like hospitality, like a hotel. If you are providing a certain amount of services and amenities, then they'll try to consider you a hotel or a hospitality industry where if you notice they have additional taxes and things that they are responsible for. So as long as you're not doing that, trying to provide concierge and things like that, that you don't want to be considered, part of a hospitality.
That
So
makes me wonder about like Airbnb.
yeah.
Does that apply, or where does that sit then? If people
Okay.
Airbnb right now, like.
Yeah. Yeah. So Airbnb is a good one. So that wouldn't apply.
Okay.
Just because the amenities are still a little bit different. It's still less than what you would get at a traditional hotel. So
Okay.
that's what the difference. Yeah. So Airbnb rentals, that wouldn't apply.
Okay.
Mhm.
Perfect. That's I think one of the common ones too. A lot of folks are
Yeah.
taking full advantage, and I think once travel is a little bit more
Yeah.
boosted, we'll see more of that come back. But
Yeah.
okay, what are some of like the common rental property deductions that are available for people?
Yeah, definitely. So some of the common deductions that are available for rental property owners,
Hmm.
I mentioned earlier the property taxes.
Yeah.
Uh, you have your interest on the mortgage or the loan of the
Hmm.
home or the property. You also have repair and maintenance. And I'll pause there too to let you know a little bit of a difference of how the IRS designate the repairs and maintenance. So if you are doing, let's say, a repair that will kind of help the home value.
Like a
Um,
roof,
a roof, for example, yes.
AC. Okay.
So what they'll want you to do is actually add that cost to the value of the home, because technically, doing the roof over or even pulling out carpet and installing hardwood floors helps the home value, helps it sell more in the future, right?
Sure.
So higher,
Okay. Yeah.
hopefully,
Right.
yeah, as well.
If you did it right. Yeah.
Yeah. And so that you wouldn't be able to deduct normally the repair for that. That would be added to the home price, the value. And then
Mm,
technically on your depreciation, you'll kind of now be depreciating off of that higher amount.
mm.
Um,
Okay.
so repairs and maintenance. But if you had a toilet that needs to be repaired, some lighting, some electrical wiring, things like that. So usually those repairs will be deductible in the year. And if you notice, I use the word normally because sometimes there'll be an additional tax rule that may change. For example, right now, depending on when you're watching this video,
Yeah.
the tax, I was confused at how, but back in 2017, the Tax Cuts and Jobs Act that was signed uh,
Hmm.
does allow some special expensing, special depreciation where you
Okay.
can actually take the depreciation. Remember earlier when I talked about 27 and a half years for certain
Yeah.
things? So a
The
lot of
depreciation.
assets have different, what's called useful lives, and that's the amount of years you depreciate it.
Okay.
But so the new tax code that's in place right now allows you to take some things at 100% depreciation in its first year, right? So
Oh.
currently, so we'll use the floor as an example. Installing hardwood floors where you would normally have to depreciate that out, you can kind of take that special, it's called bonus depreciation currently. And I think that expires about 2023.
Okay.
Um,
So we're in January 2021 right now. So from here until how long did you say? 23? 20,
2023, correct. Yeah.
2023?
And
Okay.
you just have to check to see what month, but I know it's 2023.
Okay.
It expires, or unless, the IRS and Congress decides to extend it out with the
I
presidency at
I
that
won't
time.
speak on
Yeah.
that. I won't speak on any
Yeah, there's okay.
avoid politics on this channel, sort of. I mean, it's real
Yeah,
estate,
yeah.
but
So that's what repairs and maintenance.
okay.
You yeah, so you also have, and interesting enough, travel, right? So if you have
Travel.
your property in another location that's not your home base, right? So if you,
Ah.
like myself, I'm here in Georgia, and if I had a rental property in Florida and I traveled to check on my unit, traveled to do some things for that
Hmm.
property, then I can take some deductions for traveling there.
Okay.
Even home office deductions, as long as you meet the IRS guidelines for having a home office, right? So if I'm doing any type of office work and maintaining the home, so if I'm calling, vendors or contractors to come in and work on the home and things like that, uh,
Okay.
advertising, marketing
Sounds
expense,
like a
right?
vacation is needed here and some others. Okay.
Yeah, you
This is
can.
why you have
Yeah,
a CPA, people. This is why.
yeah. Yeah, so so if you have a beach rental property and obviously
Yeah,
you're taking a trip to the beach, but you're also, checking
I'm
on your,
working.
oh, you're working, yes. So you can do
Okay.
that for those travel expenses. Let's see, contractors we mentioned earlier.
Yep.
So if you have any contractors coming in doing work,
Uh-huh.
insurance. So if you have insurance on the property,
Okay.
if you also have things like home security, any technological
Wow.
advancements you've made.
Like your smart home type of things, you mean? You
Correct.
like, okay,
Smart
okay.
home, if you purchase Ring, like a doorbell or
Right, the
camera,
ring and okay.
utilities like the Wi-Fi, things like that, security alarms, you are
Okay.
to deduct as well. And let's
Okay.
see what else I had
This is
on
a
them.
really good list.
Yeah, so there's a lot. There's a lot that you can deduct because you're running and operating that rental property.
Mhm.
So whether it's you having a long-term tenant or even if you're Airbnb or having short-term rentals,
Right.
expenses are just normal, common that you'll have for the property that you're able to deduct from that income. So
Okay.
you'll enjoy obviously the rental income. You're dishing out
Yep.
cash still to get those expenses, but then you
Yep.
don't have to worry about being taxed on the entire amount. So those are some of
I
the
love
common deductions that you should anticipate
it. Okay.
taking, and obviously you want to keep good records and track everything as you go along the year.
I should ask, is there a specific way you as a CPA prefer to have your records? Like, is it back in the day where like, I need to bring my book of receipts to your door? Like, how does that work?
Yeah, so I mean, obviously, in 2021 now, right? So in
Yes.
this virtual world, for me, I'm paperless. I think I've been, before this whole movement, I've been paperless for years. So it seems like forever.
Okay. All
um,
right.
I definitely tell people just keep track in the records. One, I guess the way that's best suited for you, but
Okay.
digitally, is the best way because you don't have to worry about paper receipts.
Yeah.
So whether that is maybe having a separate bank account to take the income and expenses out of, or having the transactions go through income and expenses for that bank account.
Okay.
And that way you're not mixing it in with your personal accounts.
Right.
And then also potentially there are accounting or finance softwares that are out there that you may find beneficial just to help keep track of it for you. And again, that
Okay.
if you're paying for those, that would be a deduction, right?
Uh,
Kind of like an office expense
right.
for the rental.
Software
Um,
for the business. Are there
exactly.
some that
Yeah.
you recommend specifically, or would you recommend any of them?
So I think I would recommend the top ones for that you would have for a business, right? So you have QuickBooks, you have Wave Financial, you have FreshBooks, you have another one called Zero. So if you kind of look up the top financial or accounting systems for a business,
Okay.
those would give you what you need to help you keep your records for your rental property as well.
Okay.
Yeah.
Excellent.
So
Woo.
it's not one that comes off the top of my mind that would actually specialize in rental property, but you never know. Someone listening to this may see that as an
Yeah.
opportunity.
Comment below. Let us know if you know some other that manage specifically for that.
Definitely, yes,
Yeah.
yes. But yeah, so those are definitely a lot of the common deductions you can,
Okay.
hope to keep track of and deduct on your taxes.
Whew. This is a lot of great information, some serious knowledge here, Rick. I really appreciate you sharing all of this. For those that may be interested, like in a consultation to learn more, what is the best way? What's your preferred way to contact you?
Oh yeah, I'm flexible. You can email me at info@modern-cpa.com.
Okay.
You can also reach out to me on Facebook, LinkedIn, and Instagram by my name, Ric Sinordo. And it'll be spelled in here. I know
It
that's
will
not
be here.
yeah, you can send me an email. You have all different ways on those platforms, and my website is modern-cpa.com. So you'll have links there to contact me.
Excellent. And you take care of clients. I know you're based in Georgia, but you have clients across.
Yes, correct. Yeah. So as a CPA, I can work with clients in all states.
Excellent.
Mhm.
Okay, that's important to know. Well, everyone, I am Jemea A Kingsby, a licensed real estate advisor here in sunny South Florida. And you can always reach out to me at Jemea.kingsby@compass.com. Be sure to like, share, follow, or subscribe. Thank you again, Rick, for all the amazing knowledge. And for everyone else, till next time, bye.